Picture this. What happens if you accidentally apply an old 1961 penalty provision to a default that happens in the new tax year 2026-27? Honestly, it's a terrifying thought for any practitioner. Hello everyone, and welcome to this explainer. If you're a chartered accountant, a tax professional, a student, or a business owner, you know that keeping up with tax law is absolutely crucial, especially when the financial stakes are so high. Today, we're focusing on demystifying Chapter XXI of the newly enacted Income Tax Act 2025. We're going to break down these complex penalty provisions from Sections 439 to 472 and translate all that dense legal jargon into clear, actionable insights that you can apply straight to your daily practice.
All right, let's dive right in. Here's our roadmap for today's explainer. First, an introduction to tax penalties. Second, the core legal penalty provisions. Third, a real-life practical example. Fourth, mandatory compliance and documentation. Fifth, common practical tax mistakes. And finally, our summary and key takeaways.
Let's start with Section 1, Introduction to Tax Penalties.
So, going back to that question we just asked, what actually happens if you apply a 1961 penalty to a 2026 default? Well, it's a massive risk. Right now, one of the biggest challenges professionals face is navigating this exact transition from the old penalty regime to the modernized framework. If you mix up the old and new laws, you're looking at invalid assessment orders, potentially massive financial liabilities for your clients, and just a lot of painful, unnecessary litigation.
But the new act actually bridges this gap brilliantly. It simplifies things by moving us away from that old, confusing duality of previous year and assessment year. We are now looking at a single, unified tax year. According to the transitional rules in Section 536 of the new Act, the 1961 Act will still strictly govern any periods before April 1, 2026. But for periods starting on or after April 1, 2026, the new tax year concept kicks in and the 2025 Act penalties take full effect.
Let's formally define what we're looking at today. Chapter 21 is the dedicated chapter within the Income Tax Act 2025 covering Sections 439 through 472. It's the comprehensive legal framework that dictates monetary penalties for non-compliance, underreporting of income, and documentation failures. This is the new definitive law of the land, completely replacing older, familiar sections like 270A and 271B.
Moving on to Section 2, Core Legal Penalty Provisions.
With the timeline cleared up, let's look at the heavy-hitting statutory rules that every professional needs to memorize. Notice how there's a direct, rigid mapping of sections to exact penalty amounts now. Let's walk through this methodically. Under Section 441, failing to maintain proper books of account, that's a flat penalty of 25,000 rupees. Under Section 446, failing to get accounts audited carries a dynamic fine. It's 0.5% of total sales or receipts, or a maximum of 150,000 rupees, whichever is less. Then, Section 447 triggers a 100,000 rupee penalty for failing to furnish a specific accountant's report. And please don't ignore the basics. Under Section 467, subsection 4, failing to authenticate PAN or Aadhaar means a strict 10,000 rupee penalty for every single default.
Now, perhaps the most critical provision to wrap your head around is Section 439. This handles penalties for underreporting and misreporting income. The new law makes the trigger for this significantly simpler. Under Section 439, you are legally deemed to have underreported your income if your final assessed income is simply greater than the income determined in your initially processed return. This is basically your new equivalent to the old Section 270A, and it's the absolute bedrock of the tax department's enforcement capabilities.
Okay, Section 3. Let's look at a real-life practical example.
It's one thing to read a statute, but as tax professionals, we live in the numbers, right? Look at this figure. 150,000 rupees. I'm pointing this out clearly because it anchors the absolute maximum financial risk a business faces under Section 446 for simply missing a tax audit deadline. That is a massive hit to cash flow for what some might just consider a minor administrative oversight. So let's walk through exactly how the assessing officer arrives at this penalty using a hypothetical business turnover. Step 1. You assess the total sales or turnover for the tax year. Let's say our hypothetical business has a turnover of 4 crores. Step 2, calculate 0.5% of that turnover. For 4 crores, that yields 200,000 rupees. Step 3, compare that calculated amount to the statutory cap of 150,000. Step 4, the law strictly dictates that the assessing officer must impose the lesser of the two amounts. In this case, since the statutory cap is lower, the penalty is locked at 150,000 rupees. It really makes the provision highly practical and predictable.
Let's pivot to Section 4, mandatory compliance and documentation.
Knowing the penalties is only half the battle. We've got to employ defensive strategies. And your absolute first line of defense against the assessing officer? Proper documentation. Here are the practical precautions you need to take. First, maintain your books of accounts strictly as per Rule 46 of the new Income Tax Rules 2026. Second, ensure timely filing of specific audit reports like Form 100 under Section 268. Third, like we discussed, authenticate PAN and Aadhaar on all prescribed documents to avoid those cascading Section 467 fines. And finally, keep highly accurate transaction records to prevent the severe penalties for false entries under Section 444.
So, the crucial point here is your ultimate safeguard. Section 470. The statute reads, "No penalty shall be imposed on a person if he proves that there was reasonable cause for the said failure." This section is your primary legal defense if you or your clients are acting in good faith. If you have that rigorous documentation we just talked about, you can leverage Section 470 to successfully defend against arbitrary penalty notices.
All right, Section 5, Common Practical Tax Mistakes.
Whenever a new law rolls out, there's always a dangerous transition period. Let's break down these common traps so you don't accidentally mix old terms with new rules. First, do not apply Section 270A for any offense in the tax year 2026-27. You have to use Section 439 of the ITA 2025. Second, stop using assessment year terminology on your new files. Transition entirely to the tax year concept. Third, don't assume the department has unlimited time to finalize a penalty. Section 472 mandates a strict 6-month limitation period from the end of the relevant quarter. And lastly, do not treat PAN and Aadhaar authentication as a casual administrative step. Doing so will trigger Section 467 subsection 4, and you'll be penalized 10,000 rupees per default.
Finally, Section 6, Summary and Key Takeaways.
We've covered a ton of technical ground today, so let's boil it down to your actionable takeaways. 1. Chapter 21, covering Sections 439 to 472, is your new rulebook for tax year 2026-27 onwards. 2. Rely on the transitional rules under Section 536 for actions relating to years before April 2026 under the old 1961 Act. 3. Penalties are now rigidly quantified. Remember the $25K for book failures and the $1.5 lakh cap for audits? 4. Section 470, reasonable cause, is your primary legal defense when acting in good faith. And 5. Always map the specific offense directly to the new 2025 Act sections to ensure completely accurate compliance.
As we step into this brand new era of taxation, I want you to ask yourself, are your internal audit systems robust enough right now to prevent a simple oversight from becoming a 1.5 lakh rupee penalty under the 2025 Act? Definitely something to think about. Thank you for watching. Please like, subscribe, and share. Disclaimer: this video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.